Welcome to the Winner's Playbook. Every winner needs a game plan, and this one's for you. Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal situation. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.
Welcome back to the Winner's Playbook. In the last week, the markets took a massive hit, and the reason, of course, President Donald Trump's dropped a bombshell during his Liberation Day speech on the 2nd of April, where he announced sweeping new tariffs. These include a 10% baseline tariff on all imports with significantly higher rates for specific countries. For instance, imports from China now face an additional 34% tariff. The result, in the first day, Wall Street went into panic mode. The Dow tumbled over 1,600 points. The Nasdaq dropped a whopping 6%, and major companies like Apple saw their biggest single-day losses in years. Today, we're going to be breaking down exactly what's happened, what these new tariffs mean for the global economy, and what Aussie investors should be watching right now. Billy, let's jump into it, mate. I woke up this morning and seen a sea of red on the share markets. What's the latest? First of all, what's been happening during the week other than the markets coming off a fair bit here?
Yeah, so I mean, it's all about these tariffs, right? So maybe if we go back a few months, like Donald Trump gets elected, Markets loved it because they thought, okay, pro-business, low tax, how good is this going to be? Market roared to new record highs. Then all of a sudden, Trump starts talking tariffs and like big tariffs. And now this week, he's announced exactly what that looks like, and it's pretty much set to go into effect straight away.
Yep.
And markets don't like that.
No, well, you know, we knew tariffs were happening, and it's usually the uncertainty and when things happen to the unexpected where you see these dramatic sell-offs in the market. And I don't think we've seen a 4 to 6% drop, or if you look at certain sectors, they're actually down over 6%. We're just looking at the energy sector in Australia, and I think that's nearly down 7 to 8% in one day. And I don't recall seeing drops like this since COVID, when we were in the sort of the height of that peak COVID uncertainty period where we were seeing sort of 3, 4, and 5% drops on a daily basis. And yeah, when I woke up this morning, I was shocked. I was like, what has possibly happened here? But let alone all it was really Trump doing what he said he was ultimately going to do. So is there really anything new there, Billy? Like what has actually happened to trigger this sell-off? Because it's usually when something comes out of the blue or it's not expected, the markets react like this. What new has actually happened?
Yeah, it's the size and scope of these tariffs and the fact they're coming into effect straight away. Like effectively, he's whacking a huge tax on all imports into the US, and it applies to every country. And in some cases, as you said in the intro, like on any imports from China are going to cop a 34% tariff or import tax. It's massive. Yeah, I mean, the US imports a vast amount of goods from China. So it's significant. And, I've got the table here. Some countries are copping like above 40%, like 40 to 50% tariffs on imports from those countries.
Well, I think I've seen Fiji was one of them as well.
What's that?
I think I've seen Fiji was one of them. It was copping like they're one of the worst hit countries. Like, little old Fiji. And there was a few other countries, like some of these, less developed countries are actually getting hit with some of the hardest tariffs.
Yeah. So, and you think, how did they come up with these numbers? On that table that Donald Trump held up in the press conference the other day, he's got this table where it's like, this is what those countries are charging as tariffs to the US. So we will reciprocate that. We'll charge tariffs on their goods, but at only half the rate. So we're being kind. And you look at the table, you're like, hang on, are China actually imposing a 67% tariff on US imports? I thought that doesn't look right. So I've dug a little bit deeper, and they actually had a formula that they used to come up with those rates. And the formula, it's not based on what the country is doing to the US. It's simply based on trade deficits. So the fact that the US buys far more from China than what China buys from the US is factored into this calculation. And the concept is, well, this is going to equalize things, and the rest of the world's screwing the US. They're exporting all their stuff to the US, but they're not buying anything from us. So we're going to whack these, bring in these massive tariffs.
Well, it's not essentially what it seems, but I suppose there is a bit of method behind the madness in a way, I guess.
It's madness, but there is a method. Yeah, exactly. But the other thing, I think we mentioned this in a previous podcast, there's also a misconception. China's not paying that tariff.
Yeah, it's a good point.
Like it's whatever business imports that good from China, they will pay the tariff in the US. And of course, they're just going to pass that cost on to the consumer. So the big fear is that we have massive inflation, like the cost of everything goes up because all of a sudden, everything they're importing, they have to pay these massive taxes and they're going to pass that cost on. So it'll be interesting to see how that plays out.
And how do you like if you're in the US? Like, how do you feel about all of this going on? I was chatting with a guy the other day that's he's from the US. He's now Australia based, but he's got a lot of contacts there, and it doesn't sound great. And if you're looking at what's happening, it's like, how does the US everyday consumer, everyday household win from these tariffs? Like, how do they actually benefit from this?
That's the big question. And there's two. I mean, Donald Trump's a salesman, right? Like he's the ultimate salesman. The way he's selling this is essentially if a business in the US and they're importing loads of cheap stuff from China or Bangladesh or something, now that they have to pay these tariffs, theoretically that business might say, okay, well, maybe instead of importing stuff from China and paying this huge tariff, we're going to need to start manufacturing that in the US or buying those goods domestically, so not from overseas, and hence paying these big tariffs. So the idea is that it will bring back, this huge manufacturing industry in the US. It'll bring all these middle class jobs back, and it'll, make America great again. Like instead of importing cheap stuff from Asia, we're going to make it all locally now, and that's good for everyone. Which sounds great in theory, but I don't know. I mean, how quickly is every business going to suddenly be opening up factories left, right, and center? And it's not that easy, is it?
No, how do you do that when like an economy's been built in the way that it has, and there's all this infrastructure, and like you can't just unwind that overnight and expect companies to adjust and change when they've probably got these trade ties that have been in for decades, like for a very, very long time, and then for a business to adjust that rapidly and as quickly as that, like I get it, but oh geez, you're being caught up in that. It's a tricky space. But we're also talking, Billy, a bit earlier around some of the biggest companies in the US, like, some of the companies in the Magnificent Seven, they're not necessarily actually going to be caught up in some of this. There are certain sort of segments of the market that are going to be impacted than others. So do you want to maybe talk to that point that we were talking about with the Mag 7 before?
Yeah. So, I mean, firstly, what is the Mag 7? That's the 7 biggest companies listed in the US. So that includes, Google, Apple, Nvidia, etc. In the case of like Google, for example, well, they don't manufacture a whole lot of products, so they're not necessarily importing a lot of goods into the US because they're a tech company, right? So some of those huge corporates may not be affected. But if you look at the likes of Amazon, for example, well, yeah, if you jump on Amazon, you're probably, vast majority of what's on there is probably not manufactured in the US. So yeah, what impact will this have on the stock market and some of those big companies? Yeah, it's unclear. And so when things are uncertain or unclear, what happens? Everything gets sold off. That's what's happening at the moment.
Yeah, and I seen in news headlines, I was just on the AFR before, and it was saying $45 billion wiped off the share market. And I always laugh when I see those headlines. I think during COVID, didn't you refer to it as, what did we call it? Did you say was it financial porn or something we were calling it? Like, it's just... Well,
yeah, I borrowed that from, there's a great advisor in the US, Carl Richards, and he calls it financial news TV, like, what's it called? Like Sky Business or whatever. He calls it financial pornography network. Because that's how you get clickbait, right? The negative headlines. When markets are going well, you don't see those sorts of headlines. So
no, and it doesn't help like the average investor though either, because you see that, and it's like I think you'd be lying to yourself if you've got some money invested. You don't actually think twice about well, should I be selling or taking some money off the table here? And then when you see those headlines, you see them in the the AFR. You get home, turn the news on. What do you see? A sea of red. It's just in your face, and the market's always, the overreact to the downside and the upside, but then the news only gets on typically the bad stuff, and bad news sells. So you got to be really careful with these little swings, because you don't want it to really knock you off and deviate your investment strategy. And providing you got the right investment strategy in place, this should really mean nothing to you, particularly if you're going to be investing for the longer term. I would say if you're approaching retirement though, you have to be really careful if you're too overly aggressive leading up to retirement, and there's that, sequencing risks of getting bad returns in those years leading up to retirement. That can really, really set you back. But what about specifically impacts to Australia, Billy? Like what do we know in terms of, I did see Albanese out on the news the other day talking about we won't be reciprocating back in terms of these tariffs. So what's the latest for Australia, mate? What are we, how are we protected, or what's happening over here?
Yeah, well, the direct impact is minimal because the US doesn't buy a lot from Australia.
Mm-hmm.
Like we don't export a huge amount to the US. And we import a bit from the US, but it's not significant. So that's why we've gotten off lightly with the minimum tariff of only 10% on any goods imported, from Australia to the US. So the direct impact, unless you're in, like I saw there was a specific carve out for the beef industry. Like Trump was cracking the shits that
Trump's got beef.
Australian beef, and he's got beef. Like we don't buy their beef, but they buy ours. Unless you're in that specific space. Aside from that, it's only a 10% tariff. So the direct impact is minimal, but the US imports a huge amount from China, and we export a huge amount to China. So China's our biggest customer, and the US is China's biggest customer, and they've now copped this massive tariff. So there'll be big flow-on effects for sure.
And well, does this then talk to a part of the, when we're investing, there's two main ways you can do it. You can take a passive approach, or you can take an active approach to your investments. And the passive approach is, the barefoot investor approach, where you put money, stick it in an index as something that's super low cost. It's going to just ideally track the market and provide you market return. But I got back from Byron Bay earlier this week, and I was at an investment leaders conference, and there was quite a few active managers. They're talking about maybe the next sort of 5 and 10 years, you're going to see maybe a disparity, and a bit more of those active fund managers actually providing some outperformance. Do you want to maybe just touch on that, Billy? Because you really sort of head up the investment side of things in committee at Link, and some of the work we do with our investment partners there. The difference between active and index investing, but active, this is kind of where, if you've got the right active fund managers in the portfolio, where this is ideally where they should be providing you those better rates of return that you would expect in an index.
Yeah, exactly right. I feel like we've hit peak index fund. Like there's been this growing trend of using index funds for many years now, because it's very cheap, it's automated. You buy an S&P 500 index fund, it simply buys the 500 biggest companies on the US market. There's no active decision making there. That's been a growing trend, and that's worked really well. And it's partly because of those 7 giant companies that have just gotten bigger and bigger and bigger. But I feel like that might unwind a bit now, because firstly, those 7 companies are just so huge that, any bad news or any change in conditions, they can get sold off really aggressively. That's what we've seen the last few weeks. And that hits index funds hard, because a third of the S&P 500 index fund will just be holding stocks in those 7 companies.
Mm-hmm.
So that's like concentration risk. Like you buy an index fund, you end up with most of your money just in a handful of stocks.
Yeah,
that's one issue. The other thing with active management is there are lots of different markets and different indexes. So you still have to decide, if you're going to use index funds, you still need to decide which index you're going to use and how much allocation into that index. So with what's happening now, there is a bigger disparity between markets. I feel like index funds, and maybe the shine's come off a bit. Maybe we do need to be a bit more active with our investing. And so that on our investment committee at Link Wealth, that's what we're looking at really carefully, is pulling back a fair bit from index style investing.
Yeah, and I think we've been meeting with quite a few funds at the moment, and you talked to the point before around which index are you actually tracking, and we've been looking at our small companies exposure as of late, and sometimes how those funds benchmark themselves. It's quite easy to actually outperform the underlying index or benchmark, but there's a broader investment universe. I think a lot of people don't actually truly sometimes understand, particularly if you've just got your superannuation fund and you see you're invested in a balanced investment option. If you actually take a little bit of a look beneath the hood there, you're going to see a lot going on. And therefore, there is a lot of choice ultimately out there in the market, like emerging markets, small companies, medium-sized, large caps, property, infrastructure, bonds, fixed interests, like private credit. Like there's a never-ending sort of universe of investors. And that doesn't mean each and every person needs to get their head around all of those things, but I don't think there's a better time than now for where you want to have some diversification and not have all of those eggs into one basket. Because if you're just exposed like 100% to the US, there's probably a lot of risk in some of that. And a lot of the big index funds actually are exposed to it just due to the natural size of the US stock market. But what have you been telling clients at the moment, Billy, like everyday investors? You know, are we deviating investment strategy at this point in time? Do we just wait and see how it plays out? It's just going to keep going down for a period of time. We know it won't go there forever. Like, what have you been telling your clients? Have you had any calls this week?
Not too many, Josh. I try and train my clients not to obsess over the day-to-day news cycle, which is difficult. But no, what are we doing? So we have been for a little while now making some adjustments to be a little bit less US centric anyway, because markets don't like uncertainty, and the Trump presidency brings quite a bit of uncertainty. And we've also come off the back of 10 years of awesome performance in the US market as well. So we've been moving a bit away from that for a while now, and we'll probably do that a bit more. In terms of what we're doing with clients, it always comes back to that specific client and their time frame for investing, their reason for investing, how they feel about risk and markets fluctuating. Like we look at that first before we then decide what we're going to invest in. So as you pointed out before, if someone's fully retired and they need their money to last for the rest of their life, they are not going to be all in on stocks. They need some defensive assets in the mix. Whereas if you have, say, a 35-year-old and we're managing their super, well, they're not going to be touching that money for 30 years. So we're not going to worry about what happens in one day or 1 week or 1 month or even a year.
Yeah.
So it depends. It comes back to the goals.
And unfortunately, I've seen a couple of clients, because we as an advisor, you usually have visibility on a client's account, and I've therefore seen a few clients change their investment options. They don't engage with me anymore, so I'm not their like ongoing advisor, but I've seen one client who has got at least a 10, 15-year investment horizon still ahead of them, and they switched out from their growth option down into a conservative one, and I've seen it. I'm like, God. You know, they've, potentially crystallizing some losses there. And I know what they're going to be doing of going, well, and I seen another client actually do this the other day, sold out and I'm going to get back in the market. And I'm like, well, when are you going to get back in? Like, you can never time the bottom of the market ever. You could get lucky and pick the bottom, but the market just will move so rapidly and it will bottom out at some point in time, and you're never generally going to be able to pick that. And then you could do the worst thing that I've seen a client ever do was sell when the markets hit the bottom because they just couldn't take it anymore. They sold and then they bought back in when the markets were right near their peak again. So they lost on the bottom end. They crystallized losses. Then they bought back in when the markets hit a peak, and then the market started to come back off again at that point in time. So I've only seen one client ever do that. Most clients are generally quite rational and will listen to what the advisor is saying. And we have that saying, sort of talking people off the edge, like they're ready to hit the sell and go to cash. But like you said, you just got to understand where you're at in life, and particularly if you're in your 20s, 30s, 40s, maybe even 50s, you still do have a long-term time horizon to invest, and therefore expect that volatility, and it's a natural given with the market. So that's why you just have to zoom out. And there's some really good charts that you can look at. And I think the Vanguard 30-year index chart is a really good one to look at. If you zoom in right in on 1 year, you see all this up and down, all the volatility, but you zoom out over a 30-year time horizon and you're generally seeing a nice sort of line going in the upwards direction of 8, 9 or 10% returns over the longer term, particularly when we're talking about the underlying share market. So It's obviously easier said than done, though. It's easier said than done. When you see your investments falling, it's not a nice feeling, I think, for all of us. Would you agree, Billy?
I agree. And what do you think about this? Like, so the last real downturn we had a bit of a downturn in COVID. That was sort of a short, sharp sell-off, should we say, or maybe you'd call it a crash, I guess, but it recovered pretty quickly. Like we're at record highs by the end of the year, I think, at that time.
Yeah.
The last sustained one we had was the global financial crisis in 2008. And if you go back and look through what markets did in charts, who did well out of that or who came out of that in a stronger position? It was simply the people who, I mean, holding on was good, but even better than that was just buying. Like markets are down, the assets are cheaper. Well, you want to invest when the asset's cheap or undervalued. So when markets fall, it presents opportunities.
Yeah, and you do the opposite. You kind of do the opposite of what you naturally, want to do. And I was just chatting with a client earlier today who's got, circa $300,000 of cash that's just sitting on the sidelines, not necessarily wanting to invest all of it. But I was having a conversation with him, and he's in his mid-50s, but got some time horizon to still invest. And I said, look, now's the time to maybe start boosting more of what we're putting into the investment portfolio. And he was going to start kicking up his investments to at least $1,000 a week moving forwards, which was a lot quicker than we were anticipating to invest that money. And I've got another client I've just coming to my mind as well, who is actually a retiree, but he sold his principal residence and he's got a couple of $1 million to invest. And I actually said to him when I was doing the advice, look, we're not going to invest all of that money in one go. He's sort of expecting a bit of volatility to come because, Trump, and when the markets have been running good for a couple of years, I don't know, I naturally just kind of think there has to be a pullback at some point here. It can't just be all sunshine and rainbows out there in the world. So I was naturally expecting something to happen at some point in time. And that's what I've been telling my clients over the last 6 and 12 months to naturally expect we will have a down year at some stage. But yeah, if you've got some cash on the sidelines, like my client who's got, $2 million to invest, or my other client that's got $300,000 to invest, starting to deploy that in these markets. And I always tell clients, if you have your favorite shop where you go buy clothes or whatever it may be, if they've got a 10 or a 5 or a 15 or maybe a 20% discount, if we start getting into crash territory, let's load up. Is my opinion, providing you're going to be investing for the longer term, because you could buy and the market could still keep on falling as well. So you do have to be careful, of course, around that strategy. But in closing, Billy, any final remarks or anything that we haven't covered off around the tariffs? Because I know obviously the US market, or some politicians are actually trying to get out there and we'll try and put a stop to Trump if they can with all of this, but that's nothing that we can ultimately control. Any sort of like parting closing words or anything that we haven't covered off here, Billy?
Yeah, look, always silly to try and predict the future, especially with politics. But we all know that Trump wants strong share markets, low interest rates, strong economies, etc. So I do feel like if these tariffs cause excessive economic pain, at some point things will ease up. So the fact that he's announced these are the tariff rates and that's it, and he's going to ram it through with like an executive order, I wouldn't use that as like the baseline, like this is what the future is. That's just what's happened this week. So yeah, just trying not to read too much into the stories day to day.
Yeah, I think that's a great way to close out, Billy. So thanks everyone that is tuning into the Winners Playbook. And if this episode helped you make sense of the chaos that we're seeing in the world at the moment, please hit subscribe, leave us a review, and share it with a mate who has been watching the headlines. And until next time, Billy, I'll see you then.
Thanks, Josh.